Financial Modeling, Topic 8, Dynamic Portfolio Simulations, Monte Carlo, Personal Financial Planning Models, and Using At-Risk. Copyright Lou Gaddis. In this topic, we're going to simulate portfolios with multiple periods, changing asset allocation and contributions. We're going to create a personal financial planning model, then use at-risk and macros to run Monte Carlo simulations. We'll also look at at-risk, which is a Monte Carlo simulation software. At-risk is available with Palisades. There's a 15-day free trial if you'd like to follow along. So here's our basic model. We can copy this and put in Excel, or you can build it yourself. We'll start with some assumptions. We'll say our individual has a $55,000 income, saving 15% of their income for retirement. Inflation and salary growth are 2.5%. Currently 25 years old. Have $1 saved, plan to live 30 years after retirement, and retire at the age of 65. My capital market assumptions: I have correlations between stocks and bonds of 0.3, stocks and cash of 0, and cash and bonds of 0.1. I'll use expected returns of stock, bonds, and cash of 7.5, 3.5, 2.5, and volatilities of 16, 8, and 2. With that, I can calculate a covariance matrix by combining the correlations and the standard deviations to calculate covariance matrices. I can then simulate this portfolio over time. So, a person starts out with $25,000. Their annual contribution is going to be 15% of their salary. And I'm going to use a simple rule for allocating their assets over their life. I'm going to assume they use the 120 minus your age rule of thumb for asset allocation. So at the age of 25, you take 120 minus 25, or 95% of their portfolio in equity. I'll put the rest in bonds, and I'll use no cash for this example. So at the age of 25, you're 95.5. At the age of 65, you're 55% stock, 45% bond. And I've just hidden some rows here. So I could highlight this and unhide it. But it's just easier to look at with some hidden rows. Just copied these formulas down, having salary grow at the salary growth rate, contribution always being 15%, and my allocation going down every year to stocks and going up every year to bonds. I then calculate the annual mean and standard deviation of the portfolio based on these weights. So the mean of that portfolio is going to be the weights times the means. Using matrix operations, that would be the vector of weights here times the mean. And then my portfolio standard deviation, using matrix operations, will be the m-mult of the row vector of weights times the covariance matrix times the transpose of the weights to the 1/2 power. And you can see your portfolio mean goes down over time, and so does the standard deviation. My ending portfolio balance would just be my initial portfolio balance plus 1 plus times 1 plus the mean return of the portfolio plus the contribution. I'm going to assume these are year-end contributions. Therefore, the return is not on the, you not get a 7.3% on the contribution, only on the $1. And then I just copy that formula down, and I get an expected portfolio value. And I just went and took this out to 85 years, even though this person is going to retire here in age 65 with an expected portfolio value of 2.051 million. I just have a VLOOKUP looking in this area for the age 65 and returns the value in the 1, 2, 3, 4, 5, 6, 7, 8th column, so you can, or 9th column. So you can see I'm looking for age 65. So if I do say the person retires at 75, it would pick the portfolio value at the age of 75 at 2.8. I'm sorry, 3.8. So I'll change that back to 65 years old. So here's our basic model. All right. The expected portfolio value is $2.051 million. And then I make a couple other calculations. If someone were to retire with a portfolio of $2.05 million and then go out and buy an annuity or create an annuity for 30 years, their years in retirement, and assuming that portfolio is invested in bonds, that has an expected return of 3.5%, I just do a payment calculation that says that that person should be able to create an annual annuity of $111,000. So that would be at age 65, you have a present value of $2,051,000. You're looking for a 30-year payment where a mean return is 3.5%, and that you should be able to generate an annual level annuity of $111,000. And I make one other calculation, that since this is 40 years from now, this first payment is going to be over 41 years from now, or 40 years from now, I calculate the real value of that first payment, in other words, in current dollars adjusted for inflation. So I take the 111 discounted at 2.5%, the inflation rate, for 40 years. Right, so that's like retiring on $41,000 a day, and that's all about the general price level increases of 2.5%. So now I have the expected portfolio value of $2.05 million, and you'll generate a retirement annuity of $111 expected, and in real terms that's $41,000. So that's my model. We're going to calculate a couple key ratios in retirement planning. The first ratio is wealth to final year income, retirement wealth at final year income, and the second one is income replacement. So wealth to income, I'll just put it over here, we'll call it wealth to income, would be your expected portfolio or your portfolio value at retirement divided by your final year salary, which would be my age 65 salary, $147,000. So I'll have an expected wealth to income ratio at retirement of 13.9, which is very good. And I can have an income replacement rate. So if I generate a salary or a retirement annuity 111, and I divide that by my final year salary of 147, I'm effectively replacing 75% of my salary in retirement. So I'll just change formattings on those and highlight them a little bit. All right, so these are key metrics in retirement planning. What is your portfolio value at retirement compared to your final year wealth? And this time I have 13 times, or almost 14 times, my final year income in wealth, and I'm able to replace 75% of my income. Let's talk about these a little bit more. The wealth to income is an important measure because it's a standardized measure of savings adjusted for income. So someone making $50,000 a year would not need or be expected to have the same level of portfolio of savings for retirement as someone making, say, triple that. Research suggests that ratios should be between, say, 5 and 15, where it is higher for those that have higher incomes. So the more money you make at retirement, the more of a multiple you'll need. The income replacement, obviously the importance is if you're making, say, $147,000 your last year of working, and you only generate a portfolio retirement savings or annuity of $111,000, you have to live on 75% of your pre-retirement income. All right. Now, research suggests that only needs to be about 30 to 70%. The reason why, and first of all, also for poorer individuals, lower income, the number probably is closer to the lower end of that range, and probably closer to the higher end of the range for middle or high income individuals. And the question might come up, well, why do you not need 100% if you want to, say, keep your standard of living in retirement? And there's several reasons. One is actually quite simple. If I'm, say, making $100,000 pre-retirement, but I'm saving 15% for retirement, I'm actually only consuming 85% of my pre-retirement income. Therefore, I'd only need to replace 85% of my pre-retirement income to maintain my purchasing power or my consumption level. So all else equal, you subtract your savings rate from 100%, and that would tell you I only need to save 70. I only need to replace 75% of my income. Another reason is we're not including, say, Social Security or even a pension from a private company. These are just portfolio wealth and portfolio replacement. Now, for people that have lower incomes, Social Security can be a large portion, or can replace a large portion of their pre-retirement incomes, maybe up to 30% or more, or 50%. And for the higher income individuals, that replaces very little. Also, in retirement, sometimes there are situations where you pay less tax. Either your income is lower and you have lower tax brackets, or retirement income is not taxed, or you've already paid tax on retirement income. And lastly, sometimes in retirement you're able to cut expenses, especially for the low income. Maybe low income individuals spend a disproportionate amount of their money on, say, commuting costs and other labor related costs or job related costs. Once you retire, maybe they just go away. And for higher income individuals, maybe that's not as significant. So for those reasons, you probably need to save between 5 and 15 times your final year income, higher if you're more higher income. And you need to replace somewhere between 30 and, say, 70% of your pre-retirement income. So now what we're going to do is do a portfolio simulation. We're going to do that by using a random walk model, one I've covered before. And the random walk model says the portfolio value is equal to, your new portfolio value is equal to the 1 plus the expected return plus a random shock. We call that a random variable z, which is a standard normal random number, times the standard deviation. So in this formula, I have that. My simulated portfolio value is equal to the value before plus 1 plus the mean, so that dollar is expected to grow by 7.3% in the first year, plus a random number, and we're going to use our Excel function norm s inverse rand. That's going to generate a random number with a 0 mean 1 standard deviation called a standard normal random number times the standard deviation. So this is our random walk model of asset prices. On average, you will get the mean because this random shock has a mean of 0. But in any given period, you cannot predict what that random number is going to be or what that random event is going to be. And then finally, I'm going to add my end of year contribution. So when I do that, and copy this formula down, and every time I hit Control 9 or my function 9, I get a new value. So every time I hit an enter, I get a new value. Or if I can go to formulas, calculate now, and you'll get a new value for the simulated portfolio value. So we can see in year 3, if I did a recalculate, F9, or if I go formula, recalculate, or calculate now, the 16,622, that'll change a little bit. It doesn't change much this year because really the shock is only on a $1 portfolio. But you can go down to, say, my year 65 income here, or my year 65 portfolio value. It's expected to be 2051, but every time I do a formula calculate now, I get a new random variable based on 45 random shocks, which are the annual shocks to the portfolio and markets. Let me copy these ratios down here. I'm going to set up a lookup here. I have a lookup here that grabs what's in column 9, I'm going to get a similar lookup. I'll just change this a little bit, looking for age 65 in this area, and grabs it what is in column 10. Alright, so 1176 is now my age 65 random number, 1176. So every time I hit F9, I'm going to get a new random simulated portfolio value. And let me update these formulas here. That should be the income or portfolio value over age 65 income. Change that. Portfolio value over age 65 income. 147. And my replacement rate, annuity, divided by final year income. Alright, so every time again I hit Alt or F9, I get a simulated wealth to income ratio, a simulated replacement rate. Now what I'd like to do is say copy this value, recalculate it say 5,000 times, and then look at say what the average portfolio value is, and maybe what some of the highest and lowest numbers are to give an idea how risky this strategy is. So I'm going to grab a function. I'm going to call it simport5000. I'm sorry, a macro. And what it does, it's a loop from I equal 1 to 5,000, next I. So it's going to run a calculation 5,000 times. It's going to put in cells 9, 12, my 9th row, 12th column, 5,000 minus I. So I is going to go from 1 to 5,000. This turns into a countdown from 4,999 to 0. Then it's going to put in 11th or 12th row, 12th column, whatever's in cells 7, 10, which happens to be this simulated portfolio value right here. That's the 7th row, 10th column of the spreadsheet. And then since it's 11 plus I, as I goes to 2, it's going to put it in the 13th row, 14th row, 15th row. So I'm going to grab that function, copy it, go to Excel. I'm going to go to my macro or my VBA area, Developer, Visual Basic. I'm going to insert a module, and I'm going to paste it in. Right, so I can verify now that's in my Excel file in module 1. It's called simport5000. And then I'm going to insert an art object, and I'll just use that to run my macro. Put that right there. And I can right click on that, assign macro. Now every time I hit this shape, it's now going to run my macro. And what it's going to do, it's going to take the value in this cell here and paste it over here again and again and again, and keep moving it down one row, and also do a countdown. So here's the countdown, going from 5,000 to 0. These are the 5,000 simulated portfolios based on the random walk model. Each one of these numbers represents a series of 45 shocks that are independent, that affect our portfolio value. So when this is done, we're going to look and see what the distribution of these look like. All done. Looks like we have 5,000 of them. Let me take a look. All right. We'll actually give those a range, a name range. We'll call those Sims. All right, so I just gave a name range of that column. All right. Now we're going to look at the distribution of that series. So let's look at the the mean, the 5% largest, and the 5% smallest portfolio value, and then we'll use that to calculate an annuity and real annuity. So let's do simulation results analytics, and we'll look at the mean portfolio, and then we'll look at the 5% smallest, 5% largest, and then we'll also look at the retirement annuity and then real annuity. Okay, so if I just take an average of SIMs, it's just an average of this column down here. You can see my average is about 2.02 million, which is close to what the expected result is. And in fact, if I did this for, say, 100,000 iterations on my macro, I would start to converge towards this value here. I can then calculate the smallest value in this by sorting this column and seeing what the, say, 5% smallest. Since there are 5,000 observations, 5% of 5,000 is 250. So I would sort this from low to high and take the 250th smallest, and then I take the 250th largest. But I can use Excel's small and large function. So I can do the small of the array of SIMs, and I'll look for the smallest 250 value. So the smallest 250th value is $800 and some thousand. And the largest, I can use Excel's large function, is $4 million. Based on that, I can just use these calculations over here for retirement annuity and real annuity, and hopefully they'll link correctly. So it's looking at the number above and calculating a payment, and then looking to discount that. So what you see is our portfolio is expected to have a value of 2.05 million. Although with our limited 5,000 iterations, we didn't get quite as close as I'd like, but it'll be usually on average about 2.05 million. However, the 5% worst case scenario is, looking at these observations, would be retiring on a portfolio value of 866, which then gets us an annuity of only, in real terms, $17,000. And the 5% largest gives us an annuity of $81,000. So the simulation allows you to think about how your choice of portfolio weights and asset allocation, which then affects the portfolio standard deviation, how that affects the risk that you do not achieve your expected portfolio value of about $2 million. So this is the process of Monte Carlo simulation. Create a model where you choose some outputs or calculations you're looking to analyze. That would be, say, mean, retirement annuity, and real annuity. We then select a variable that we can make a stochastic variable. That variable is asset return. We'll assume that asset returns are normally distributed. We'll then simulate many different asset random variables, asset return and random variables, using my normal S inverse ran. So every time I hit recalc, and actually every time the macro pastes a number here, an automatic recalc occurs. That's why I didn't have to do a recalc in between every one of those. So I generate a series of 45 random numbers for the norm S inverse ran, and they're all different inside these cells. That'll generate a new portfolio value. Paste it here. Then as that paste, I get a series of 45 new randoms, gives me a new portfolio value, paste it here, and then we evaluate the distribution of those two variables to help us make decisions. Maybe we like to get a safer portfolio, or maybe we like to have more equity. So that's simulation. One little exercise we could do in practice of using macros is we could try to change our macro to also keep track of these other simulated variables, say wealth to income. So this is portfolio value. But what if you want to track wealth to income and income replacement? Well, I'll need to keep track of where everything is. That means as every time I hit F9, I get a new wealth to income and new income replacement. Wealth to income is in 711 and replacement is in 811. So I can go 711 and 811. Let's take a look at my Visual Basic. I could add some more code here. I can copy this formula. So I said 711 and 811 are my values for wealth to income. So it's 711, 811. Again, my portfolio value is in 710. So one down, one over would be, I'm sorry, one over would be 711, and then one down would be 811. So that looks right. And then what I want to put it is in this column here. Now the portfolio is currently going into column 12. So let's put them in column 13 and 14. Alright, so it's going to put them in columns. When sets I equal to 1, we're going to get in column 12. I'm sorry, row 12, column 12, 13, and 14. So if I were to run my macro now, it should be taking the values here, paste it here, here, paste it here, here, paste it here, and there it goes. I'm going to stop it before it ends by hitting escape twice and hit end. Alright, so that's a little exercise to see how to use that macro. Last thing we're going to do, we're going to use @risk. @risk is a software offered by Palisades. It allows you to do a Monte Carlo simulation using their interface. To use @risk, we're going to just make a few modifications. So for @risk, to specify where to generate a standard normal random variable, you don't use norm s inverse rand. Use risk normal 0, 1. Oh, by the way, you can't do this unless you've actually launched @risk and see the @risk tab up here. So I've replaced norm s inverse rand with risk normal 0, 1. Now what's going to sit in the cells is 0. So it's going to be 0 times standard deviation. So what's going to give you is actually the expected portfolio value. I'll copy that down. So now I've generated all those random numbers in these cells using @risk. And then all I need to do is tell @risk the output that I want to keep track of. In other words, the output I want to see a graph of. And I could highlight, say, all 3 of these if I want to keep track of all 3 of these. Click on @risk, add output. And go on @risk also, you can see that if you go to your model window, what you see is I've inserted a bunch of risk normal 0, 1. So this would be all those years. And I created 3 outputs. Now if I click on my portfolio value and go to @risk and do 10,000 iterations, it's going to generate 10,000 portfolio values based on sets of, in this case, 45 randoms each time. And I'll start the simulation. This will give me a graphical display of the histogram of portfolio values, Shows me my 5% smallest portfolio value, 860,000. Put data in million. Notice that ties to what we got doing our homemade simulation. And the 5% highest simulation is 4.15 million, which also roughly ties to what we did here with 5,000. If we want to see the other statistics, we could just click on, say, retirement annuity, at risk, browse results, and see, say, the 5% lowest and 5% highest retirement annuity. That's nominal. Now, if we want to play with this, we can also look at different intervals. Say, what is the 80% confidence interval? 10% in each tail. So now you have the 10% lowest, 10% highest. Or you can say, well, what's the probability we retire on $50,000 a year? Well, there's a 7% chance of retiring on less than $50,000 a year, and I could drag this over. There's a 93% chance I'll retire on more than $50,000 a year. So that's using at risk to run a simulation. Remember, when you save a file that has a macro, you do a file save as and save it as a macro-enabled workbook. And then it'll ask you whether you'd like to save your at-risk results. Right, so in this topic, we'll try to review. We looked at simulating portfolios with multiple periods, changing asset allocation and contribution, created a personal financial planning model, used at-risk and macros to run Monte Carlo simulations. And the last thing I want to show you is using goal-seek and at-risk. In at-risk, you can also do a goal-seek, just like you do in Excel, kind of like a solver. Under Advanced Analysis, goal-seek, we could ask, say, we want to set our simulated income replacement rate to a value of, say, 0.6 if we want. So by changing savings rate. So in this case would be if we determine that we only need to replace 60% of our income. At risk, we'll run the simulations, trying to figure out how much should you save to target a mean average replacement rate of 60%. I can analyze. It'll ask me to make this an output. And that might take a minute. It'll go faster than what you think. It'll start off slowly, then finish rather quickly. And then it'll show you what savings rate you need to have a goal of replacing 70 or 60% of our income. We'll hit yes. And looks like the answer is save 12%. And one other thing at-risk can do is it can run another type of goal-seek where you don't just target a mean. Say you want to have a percentile. You want no more than a, 25% chance of retiring on 40%. Replacing 40%. So in this case, you're targeting a percentile. You're asking how much do we need to save so that our 25% lowest replacement rate is 40%. I'm not sure how this will go, but we'll see what that number is. The last number again was 12%. You see down here it's doing 2,000 iterations per second. And it looks like that answer is also about 12%. Alright, so that's using at risk to do a goal seek or a solver.